In this video, we're going to fully explain how option sellers make money by understanding the difference between implied and realized volatility. You're going to learn what implied and realized volatility actually are, how they affect option pricing, why the variance risk premium exists, or the difference between implied and realized volatility, and how option sellers use this information to actually make money. So first, you need to know what these two terms really mean. Implied volatility is the market's forecast of how much a stock price is going to move over a given time period. It's the amount of movement that options are actually pricing in. And then realized volatility is how much the stock actually moves over that time period. And that number is based on the real price movements that we see. So remember that options are priced based on the implied volatility, how much the market thinks things will move in the future. But the amount of money we make or lose as option sellers is based on the realized volatility, what actually ends up happening. Prices are based on forecasts, profit or losses are based on reality. Now, on average, implied volatility tends to be higher than realized volatility. And why is that? Well, it's because of why options exist in the first place. These are hedging tools. People use them to protect themselves against large risks. The people who buy options know that on average they're going to lose a little bit of money, but the benefit they receive is that when there are big swings in the market, they are going to be protected from risks. They're basically willing to pay for protection against uncertainty. And this persistent gap between implied and realized volatility is what we call the variance risk premium. It's the tendency for implied volatility to overstate realized volatility, and it's something that's been observed for decades. And this is why systematically selling options, under controlled conditions actually has positive expected returns. Let's walk through a real trade example to help you make sense of this. Imagine a company is trading at $100. You sell a 30-day straddle by selling the at-the-money call and the at-the-money put. And let's say when you do this, the market was implying a 30% move and the straddle was going for, $8. Meaning, if the stock stays within an $8 range of that 100 strike that you sold, then you are going to be profitable as an option seller. Let's say that Apple only moved 5%. Well, when we do the math, you would see that the options ended up expiring with less movement than expected, and therefore you came out profitable as an option seller. You sold volatility at the implied rate, but the realized movement was less, and therefore you generated a positive return. Now, if you're taking option selling seriously, you got to generally understand these concepts before you get started, because without it, it's hard to actually price risk appropriately, which is what we're doing as option sellers. And without understanding this, if you're just placing trades, it's hard to know if what you're seeing is in line with what you should expect, or if you're just getting lucky. It's going to be hard to build something systematic and reliable if you don't know these types of concepts off the back of your hand. Now, talking about implied volatility, market sentiment plays a huge role in how things are priced. During times of panic, fear, and uncertainty, we tend to see implied volatility increase significantly. And when things are really calm and casual, implied volatility tends to come down. But realized volatility, on the other hand, that can behave completely different. Sometimes when investor sentiment includes a lot of panic, things actually move less than realized. And then in other times, realized volatility can explode way beyond what was implied. For example, leading up to earnings events, implied volatility always rises as people start to price how much they think the stock will move around the event. But we also see that a lot of times this implied move is so much higher than the realized move. And this is an example of how investor sentiment and the willingness of option buyers to actually pay a premium creates an environment where implied volatility tends to overstate the realized. Now, something I want to mention is that when it comes to these concepts, you need to just generally understand them before you get started. Don't get lost in the land of theory, understanding every single little detail before you get out there and just sort of see it for yourself, even if it's on a paper account. And so when you're ready to take a leap with a couple strategies that make sense, have a bunch of evidence backing them, take a free trial with Predicting Alpha using the link in the description below. You can basically come in and steal my 5 systematic strategies that we run together as a community. Of course, using the tools and stuff that we also provide is going to give you a huge leg up. But even if you just wanted to get started and see what running a good option book actually looks like, you're going to get a lot out of that 7-day free trial. And so go ahead and take one. I'll see you there.